Today, I would like to talk about risk and return, which are the fundamental concepts underlying all the theories of asset pricing. First of all, let me explain to you why those concepts are particularly important for us. We'll start with the simplest cases, and step by step we will proceed to more complicated examples. So, in the two previous sections, we have studied the fundamentals of debt and equity pricing based on the discounted cash flow approach. So far, we did not pay too much attention to where the expected return on a security comes from. We have mentioned, though, that the expected return on a security used in the DCF-based valuation can be treated as the opportunity cost of capital, which is the return of an alternative investment carrying the same level of risk. However, in practice, it's rather tricky to find such kind of investment. That's why we have a different way to approach to the estimation of a security return. So, in this section, I would like to question myself, how can we estimate the return on a security? Indeed, talking about return, we need to distinguish between the two types of a return. The return I have been talking about is called the required return, and this is an example of an external estimation of the stock return. However, we can also find out what the expected return on a security is by observing its past performance at the market. In this case, the expected return will depend on historical prices of a security, which is in turn the internal estimation of the stock required return. The most important thing is that in a perfect market, which acts as the theoretical background for most of the financial models, an expected return should be equal to the required return on a security, meaning that indeed, in a perfect market, as we have previously discussed, the net present value of investing in any financial security will equal zero. Indeed, if an internal return generated by the security equals the external return required by the market, then indeed we can conclude that the asset is priced correctly. In this case, by putting the equality sign between the expected return and required return, we may have a chance to determine the required return based on expected returns. So how we determine a single period return on a security? In order to do that, let's consider a very simple example. Suppose yesterday you purchased one stock for $100 and today you sold it for $102. What is the return on this transaction? I believe it's easy to calculate that as your wealth has increased by 2% over just one day, then your return on this transaction will be 2% if the price goes up to 102. On the other hand, the price may decrease, and if today you sold your security at the price of $95, then your return will be a loss equaling to minus 5%. So, in this case, we can see that a return on a single security is based on the price and derived from it. That's why we can say that the return on a single security is the function of the stock price. And as we have seen on this example, it can be either positive or negative. In the previous example, we have calculated the daily return on a stock. However, we can use a different frequency. For example, we can compare the prices at the end of each week, or at the end of each month, and even at the end of each year. In these cases, we will be calculating weekly, monthly, and annual returns, respectively. These may be pretty much different from daily returns, of course, and the frequency of our return calculation is generally determined by the sample that we are analyzing. So, as an example, I have considered the daily returns of Apple Incorporated stock over the 3 years from 2018 to 2020. I started with collecting the closing prices for this stock and then calculating daily returns as a percentage change in the price compared to the closing of the previous day. So in this example, I had about 750 observations of daily returns, about 250 each year. And now I have to process this information to make a more general conclusion about the return on Apple Incorporated stock. For example, taking a look at the daily returns of Apple Incorporated stock in historical perspective, we can see that from day to day, the return on that stock was pretty much different. We could observe some days with high volatility when the exchange recorded a big increase as well as the big decrease of the stock price. In other days, however, the change was not so dramatic, and in most cases, the fluctuations of the Apple Incorporated stock price measured by its daily returns was not very significant. In this case, taking this sample, including about 750 observations, we can make the distribution of these returns by using a histogram. Here you can see it on the picture. As we can see, indeed, in most observations corresponding to most days, the daily change of Apple Incorporated stock, which is the daily return of Apple Incorporated stock, was not so big. In almost 180 observations, it stayed within quite a narrow range between minus 0.5 and plus 0.5%. However, more dramatic changes in Apple Incorporated stock price did not take place too often. As we can see, the tails of these distribution are rather thin. We can observe the same type of distribution for almost all types of financial and non-financial assets traded at the market. In statistics, such kind of distribution is often approximated by normal distribution, which is a very frequently used function in statistics. As we can see on this example, the returns of Apple Incorporated measured using daily returns also may follow this kind of normal distribution. So how do we determine the expected return on a stock? An expected return, which is the same as the mathematical expectation, can be equal to the average historical return over the observation period. In our example, the observation period was 3 years. So the expected return is the average historical return and can be calculated based on daily, weekly, monthly or annual returns depending on our goals and objectives of our study. That means that indeed, talking about the future, we need to look into the past and we extrapolate the returns observed during the historical period for the forecastable future. This is one of the underlying assumptions of the portfolio theory, and I will refer to it in the next section. As I have already mentioned in the previous section, the required rate of return is the return of an alternative investment with the same level of risk. Now we know that we take expected returns as the measure of returns. But how can we measure risks? In this case, we will talk about the definition of risk in financial theories. Overall, I would like to say that when it comes to analyzing financial models, we think of risk a bit in a different way compared to how we treat risk in our real life. For example, we generally say, "What's your risk of losing money?" However, we can hardly ever hear words, "What's your risk of gaining money?" That means that generally we imply that the risk is the probability to lose rather than to gain, which is pretty much understandable from our daily experience. However, this makes the difference with how we treat risk in financial models. In finance, the most appropriate synonym to risk is volatility, which can be also described as uncertainty about the value of your investment in future, which can be treated both ways. So, in other words, we can say that the more uncertain we are about the future prices and returns of our investment, the more volatile this investment is, the higher risk it contains. So, now that we know what is the economic treatment of risk, we need to measure it. There are several alternative ways how a risk can be measured. However, when using historical data, the most popular one is based on such a statistical indicator known as variance and standard deviation. As it follows from the formula on the picture, in order to calculate variance, we need to make an average between the average value of an observed return and a single period observed return squared. If we summarize all those squares and divide it by the number of observations, we can find out what we call the variance of the stock returns. However, in practice, we generally use standard deviation, which can be easily calculated as the squared root of variance in order to measure the risk of a security. Very soon we will figure out why. In order to make this concept more comprehensive, let me consider another simple example of risk calculation. Suppose we observe the returns of the two securities over just 1 week. We already know that the single period returns or daily returns are calculated based on the historical prices we observed over this week. So in this table, we already have these returns calculated. Based on 5 observations for each stock, we can work out the average daily return for each of these. That will be equal to 1% for both securities. Now let's determine the variance of these stock returns by using the formula I have demonstrated. In order to do this, we sum up the squared differences between the average return of 1% and the current single period return for each stock and divide it by the number of observation, which equals 5, as we are only considering the stock performance during a single week. As we can see, the variance for stock 1 is lower than the variance for stock 2, and so the standard deviation is. In this case, I would like to mention that even though practically it makes no difference between calculating variances and standard deviation, I mean that if a stock shows higher standard deviation, it's likely to show higher variance as well. Still, most analytics prefer standard deviation because, as it follows from the formula, it is measured in the same percentage points as expected returns. For this reason, we can look into those figures and make economic treatment for these standard deviations, something which we cannot do with returns variances. There is another important thing I would like to note based on this example. As we can see, we calculate variances and standard deviations of those stock returns based on the returns for these stocks. However, as we know from the previous sections, returns were calculated based on the historical prices, which means in turn that the standard deviation of returns is also calculated on historical prices. So we can summarize that the standard deviation of a stock return is the function of the stock price as well. So if we make the graphical interpretation of this numerical example, we can see that indeed the returns on equity 1 are more concentrated around the average return of 1%. However, the returns for stock 2 are more dispersed. We also remember that these stocks carry equal expected return, which is 1%. So now it's time to formulate the first rule of a rational investor, and it can be put forward like this. Given that two securities carry equal expected returns, rational investors always prefer the one with lower risk. I would like to illustrate the first rule of a rational investor based on this example. Here we have two types of investments, A on top and B on the bottom. So my question is, which of these two investments will be chosen by rational investors? The correct solution is B. The first thing we observe is that these two investments have the same mean or expected return, equal to 10%. However, what makes the difference is the distribution of those returns. We can see that the returns for investment B are more concentrated around its expected value. However, the tails of investment A distribution are bigger, which in turn implies that we can forecast the price fluctuations for investment B with higher certainty. However, there is a higher probability that we can observe extremely high or extremely low returns for investment A. So the conclusion is that indeed, as these two investments carry the same expected return, A is more risky, and therefore all rational investors in this case will prefer investment B. We can put this example further by considering another couple of equities, 3 and 4. In this case, we also take the set of daily returns over just the same week. And we use the same calculation methods in order to estimate the expected return over this week, as well as variances and standard deviations of these stocks. As we can see, these stocks make no difference in terms of standard deviations. However, equity 4 provides us with the higher expected return. This drives us towards the second rule of a rational investor. We can conclude that given two securities provide us with equal level of risk, then rational investors prefer the one with a higher expected return. So here again, you can see the graphical illustration of the previous numerical example. As we can see, the variance for these two stocks is more or less the same, as the returns fluctuate in almost the same extent. However, we can see that the curve for equity 4 generally tends to lie higher than the curve for equity 3, which implies that in average, equity 4, being of the same risk, is likely to provide a higher return and thus has to be chosen by rational investors. Let me ask you another comprehension question now concerning the second rule of a rational investor. Now you can see the distribution for another couple of investments, B and C. Which one will be chosen by a rational investor in this case? I believe it's clear that these stocks' returns are distributed equally in terms of risks, as the histogram has the same shape. However, we can see that investment C carries a higher average, also known as expected return, and thus, given the same risk, it's more attractive for rational investors. Now we are about to put these two rules all together to formulate what I call the third rule of a rational investors. We can say that indeed a rational investor can tolerate the increase of risk only if they are rewarded with appropriate increase in expected returns. Or we can formulate this just in the opposite way, saying that rational investors can tolerate the decrease of expected return only if they are rewarded with appropriate decrease of risk, which illustrates the commonly understandable rule that the investments with high risk should have higher potential return. However, low-risk investments are likely to have lower returns. So this illustrates the general relationship between risk and return, which is generally understandable. However, there is just one word in this rule which draws my particular attention. This is the word appropriate. So let's think about it. What does appropriate mean? For example, is the increase of return by 1% an appropriate reward for the increase in the standard deviation of 1%? Or should we require a higher increase in returns, or maybe a lower one will do? This is the question we will be considering in our next topic, because this is one of the most important questions in finance. What is the optimal relationship between risk and return in this market? What is the optimal slope of this line which shows us the relationship between risk and return? We will consider these questions later, but at this point I would like to make the bottom line and summarize what we already know about risk and return. So, in the modern portfolio theory we will be considering very soon, we will take return as expected return, which is historical average return over the observed period. We take the standard deviation of returns as the measure of risk, which can be also called our historical volatility. That means that in order to estimate the future risks and returns of our stocks, we use historical data and we make an implicit assumption that the status quo will remain. I mean that indeed those assumptions imply that securities with higher historical returns are likely to achieve higher returns in future as well. And on the other hand, securities with high historical volatility also tend to be more volatile in future. This assumption should be stated very clearly because this contains all the limitations of the financial models we will be considering afterwards. Indeed, these models imply that the status quo will remain, meaning that there will be no structural changes at the market, there will be no fundamental change of the company's performance. Of course, we know that in real life it doesn't go like this, and as the company becomes more mature, its returns are getting more moderate, but the risks of investing in this kind of a security are also going down. It may be an opposite case as well. When the company is in distress, it may have its risks increased, and the investors will also claim a higher return for this kind of a company. However, in our financial models, which include the portfolio theory, the Markowitz model, and the Sharpe model, we will base all our workings on these assumptions, and that's why it's particularly important to understand them clearly. Up to this point, we discussed how the risk and return for a single security can be estimated. However, in practice, investors hold portfolios that contain a big number of securities. That's why, in our next step, we need to identify how we can estimate the risks and returns for the bigger holdings containing various types of securities. In this part, we will discuss a particular case for a portfolio which comprises only 2 assets. So how the expected return of a 2-stock portfolio will look like? This is an easy question. We can simply find out the weighted average of the expected returns of these 2 stocks in order to estimate the expected return of such a 2-stock portfolio. For example, if we have 2 stocks, A and B, with expected returns 4 and 12% respectively, and the weights in the portfolio equaling to 30 and 70% respectively, then we can indeed apply this weighted average formula to work out the expected return for this portfolio. We can observe that the expected return of a portfolio is closely linked to the weights of these stocks. If we increase the weight of the stock with a higher expected return, then the overall expected return of our portfolio will go up. However, if we decrease it, the overall expected return of the portfolio will go down. Estimating the variance of the portfolio, which contains 2 stocks, however, is a trickier thing. The thing is that stocks tend to move in different directions from day to day. For example, one day both stocks may go up, but however, their returns will be different. Next day, one stock may increase in value and the other one will decrease. Finally, during some days, both stocks fall, but again, the returns will be different. That means that in practice, there is hardly ever possible to observe perfect correlation between the 2 financial assets. That's why, if we have 2 assets in our portfolio, the changes in their returns tend to eliminate each other, thus making the overall return of our portfolio measured as a daily return a bit smoother compared to a return of each particular security. So that's why we should consider such a statistical indicator as a covariance, which measures how the returns of the 2 assets move along. Here you can see the formula of the covariance on the bottom of this picture and how we incorporate the covariance formula into the estimation of a variance for a two-stock portfolio. You may ask, where does this equation come from? Well, technically, we can reckon from the statistics course that the variance equals the sum of the covariance metrics. For two stocks, these covariance metrics will contain four sections, which is the weight of stock 1 squared multiplied by the covariance of stock 1 with itself, which equals to this stock variance, plus two covariances of stocks 1 and 2 multiplied by the weights of those stocks. So to make it a bit easier, we can rewrite these covariance metrics in the following way and produce the final equation for variance. However, in practice, just like variance, which I mentioned in the previous section, covariance is not a popular indicator used in order to see how the assets of the two stocks move along. Again, the reason is just the same. By looking at covariance, it's very hard to make an economic interpretation of this figure. That's why, in practice, the correlation ratio is a more popular indicator to estimate the link between the returns for the two securities. Correlation ratio can be defined as the covariance of the two stocks' returns divided by the standard deviations multiplied for each of these stocks. The correlation ratio is a more convenient way to look into the relationship between the stock returns because it's a normalized indicator. It can only change by definition between -1 and 1, with 1 being the perfect correlation of the stock returns and -1 being the perfectly negative correlation between the stock returns. So now we see that we need to incorporate another unknown into our workings. We do not only need to estimate the standard deviation of the stock returns in order to calculate the variance and the standard deviation of a portfolio. We also need to know how, to which extent these returns move together. So we need to know the correlation ratio of the stock returns in order to estimate the portfolio risk. In this example, we can see that the stocks with the standard deviations of 9 and 16% respectively have the portfolio weights of 40 and 60% respectively. While applying the formula for the variance and the standard deviation as a squared root of variance, we can work out that the standard deviation of the portfolio, which contains 40% equity A and 60% equity B, will equal 11.8%. We can observe that this number is lower than the weighted average standard deviation of these two stocks, which is a very important implication of this idea. So let me make a more general view of what I'm talking about. Of course, these two stocks, A and B, may have very different return correlations as they are calculated based on historical data as well. If the stocks are perfectly correlated and the correlation ratio is +1, then the formula for variance is simplified to the sum squared. That's why, taking the square root of this formula, we can work out that indeed the standard deviation will be a linear function, just like the expected return, if the stock returns are perfectly positively correlated. On the other hand, if the stocks are perfectly negatively correlated, with the correlation ratio being -1, then our formula collapses to the difference squared. And again, it can be described as the two straight lines. And at some point, these two straight lines will cross the vertical axis, meaning that it's possible to compose a portfolio which will have the standard deviation equal to 0, which is the only situation when we can compose the risk-free portfolio by taking two risky assets. At any correlation ratio which is in between -1 and 1, there is no shortcut to calculate the portfolio variance and standard deviation, and the relationship between the portfolio standard deviation and expected return will be shown by a curve somewhere in between these triangle, somewhere inside it. The main thing is that all the portfolios we can construct by using stocks A and B, provided that we cannot short sell securities, should lie on these straight lines or curves between A and B. So all the possible set of portfolios can be found there. And we note that the return correlation has the negative effect of the portfolio risk, meaning that the lower the correlation between the two stocks, the lower the risk of the portfolio, which comprises these two stocks, all others taken equal. This is a very important idea which I will develop in one of the next sections when talking about diversification. Now that we are familiar with the calculation of expected return and the risks of a portfolio of two stocks, let's generalize our workings and see how we can estimate the expected return and the risk of a portfolio with a bigger number of securities. Indeed, it's not that complicated for expected returns. Just like in the previous case, an expected return of the portfolio, which includes n stocks, will be still the weighted average of these stocks' expected returns, no matter how many assets we include. However, it makes a difference in terms of variance. As we know from the previous section, the variance of the two stock portfolio equals the sum of the covariance matrix, which contains 4 cells. That example, however, was a particular case for the covariance matrix for an n stock portfolio. So if we extend the size of these metrics and include, for example, 2 more assets, then we will need to summarize all those covariances multiplied by the weights for the matrix, which will contain 16 cells, including 4 variances and 12 covariances. In the most general case, the variance of an n stock portfolio will correspond to this formula. Please pay attention to it because we will need this formula to derive the approach to diversification in the next section. However, still, in general, it makes no difference with the previous example, as we still need to summarize all the cells in our covariance matrix in order to work out the variance of an n asset portfolio. Now let's see a bigger picture. As we already know, we can represent each particular security as a point in the mean standard deviation chart. Here, for example, we have 6 different stocks. Each stock has its own expected return and standard deviation different from the others. What if we try to combine each couple of stocks in a portfolio, provided that the returns for each couple of stocks are perfectly correlated, which can act as the most conservative approach to the portfolio valuation. In this case, all the possible sets of portfolios will lie on the straight lines connected all those points, as illustrated on this picture. In practice, however, the returns on securities do not tend to be perfectly correlated in most cases. That's why the curves connected each couple of stocks tend to be convex. Even more, I would like to say that investors can not only limit the number of their securities in their portfolios by 2. Their portfolios can contain 3, 4, and a bigger number of securities, which implies that other investment opportunities are also feasible. So, if we generalize our observations, we can say that we can indeed create a broad variety of portfolios by using these 6 assets, not only limited to the portfolios lying on these green lines, but also the portfolios which appear in this shaded part inside the curve, which is called the feasible region. In other words, we can say that the feasible region illustrates the supply for the assets which is available in the market, and as those assets are feasible, then all the portfolios we can create by buying these assets in different weights are also feasible. We will need these results when talking about portfolio theory and Harry Markowitz model, so please pay specific attention to it. Important thing that we have to mention when talking about risk and return, and which plays a particularly important role in portfolio management. Of course, I mean diversification. I believe that we all understand what diversification is from our day-to-day life. Indeed, in financial investment, it makes little difference. Indeed, diversification is a strategy of mixing a wide variety of investments within a portfolio in order to reduce risk. For example, we can diversify our portfolios by selecting different types of securities issued by the same company. As they tend not to move in the same direction, diversification will have the positive effect of our relationship between risk and return. However, still, holding the securities of the same issuer, even of the different types such as common stocks, preferred stocks and bonds, is not the strategy which will guarantee that our portfolio will be diversified, as we're still exposed to the risks carried by a single company. A wiser solution is to include stocks and other securities issued by different companies, thus reducing the company-specific risk. We can also include the securities issued by the companies from a different sector in our portfolio, because we cannot call the portfolio which contains only the stocks of oil companies a well-diversified one. We can also diversify our holdings by market or by country, which will also reduce the country-specific risk if all the investments in our portfolio originate from the same country. We also know that some countries, like the countries from the European Union, share the same currency, which means that all investments in the same currency, like euro, are exposed to currency risk. That's why by including the stocks from the different markets, like British or American stocks, into our European portfolio, will make even a better diversification because the currency risk of our holdings will be reduced as well. Of course, the main benefit of diversification is that it helps us reduce risk. Of course, generally, at the same time, the expected return can be also decreasing. However, the point of diversification is that generally expected returns tend to decrease slower compared to risk, which follows from the fact that this is a non-linear relationship between the standard deviation of a portfolio taking the different weights of our securities in the portfolio, which we have considered before. But there is another question which I would like to ask. Does diversification have limits? Can we completely eliminate risks by diversification? For this reason, let's take another look at the same old covariance metrics we considered in the previous section. Indeed, let's question ourselves, what happens if we increase the number of stocks in our portfolio up to infinity? To what extent would the overall standard deviation of our portfolio change? Suppose we are dealing with portfolios in which equal investments are made, in each of n stocks. The proportion invested in each stock is therefore 1 over n. So in each variance box we have 1 over n squared times the variance, and in each covariance box we have 1 over n squared times the covariance. So overall there are n variance boxes and n squared minus n covariance boxes. Therefore, by proceeding with the workings, we can see that the overall portfolio variance will be 1 over n average variance plus 1 less 1 over n multiplied by the average covariance of each investment with each other. Thus, if we stream n up to infinity, making the number of stocks in our portfolio unlimited, then we'll see that the first part of our equation, as n goes to infinity, would collapse to 0, and the second multiplier for the average covariance will collapse to 1, which means in turn that as the number of stocks in our portfolio goes up, then if it goes to infinity, then the portfolio variance will go to the average covariance of each stock with each other. This is the limit to our diversification. So in other words, we can diversify away our risk only to a certain extent, which equals to the average covariance of the stocks available in the market. This limit of diversification is illustrated on this chart. Indeed, at first step, the increase of number of securities in our portfolio creates a visible and positive effect, and we can indeed eliminate our risks by increasing the number of securities in our portfolio. However, as we keep on increasing the number of securities, then the overall effect of risk reduction will be fading. Indeed, there is a big difference in terms of risk for the portfolios containing 3 and 10 securities, for example. But there is just a minor difference between the risk of a portfolio containing 100 and 150 securities, for example. In this case, I would like to say that we should distinguish between diversifiable risk and undiversifiable risk, which is also referred to as the market risk, which, as I said before, is our limit to diversification. Another name for market risk is systemic risk, which can be defined as the risk of investing in a selected market in general. Indeed, by streaming up the number of securities to infinity, we're always limited by the capacity of the market we're operating at. That means that if we increase the number of stocks to the overall capacity of the market, we will still carry the risks of investing in that particular market, including legal, political, and currency risk. If we are not okay with taking these risks, the only way out is not to invest in this particular market, because we know that different countries and different financial markets have different level of systemic risk. However, the risk of investing in a particular security, also called non-systemic risk, can be eliminated by diversification, and if we increase the number of securities up to infinity, then we have a chance to reduce non-systemic risk completely. However, the extra return offered by investing in particular securities will also be fading, as if we extend the number of our investments to the overall size of the market, we will not be getting more than the average market return. In the previous lecture, we introduced the fundamental concepts of risk and return used in finance. We also posed a very important question: what is the optimal relationship between risk and return in a given market? So far, we have no answer to this question. That's why we need to proceed and study the portfolio theory in order to understand what is the optimal proportion between the risk and return of a given investment. In order to do this, we first refer to the assumptions behind the modern portfolio theory, including some extra assumptions which we need to make in addition to what we already know. Then we'll proceed to the portfolio of risky assets and see what determines the investment choice if the investors are only able to invest in risky portfolios. Then we will introduce the so-called two-fund separation, meaning that investors also have a chance to invest in risk-free assets as well, and see what determines their choice. Finally, we'll also get introduced to some important tools in measuring the relationship between risk and return, called Sharpe ratio and Sortino ratios. So, let's get started. The person I would like to introduce you to is called Harry Markowitz. He's best known for his work in the modern portfolio theory, studying the effects of asset, risk, return, correlation, and diversification. His key research papers were published in 1950s, and he was awarded the Nobel Memorial Prize in Economic Sciences in 1990. However, his research papers are still among the most quoted research in finance. So, first, let's refer to the key underlying assumptions of the Harry Markowitz portfolio theory, which also hold for the risk and return framework, which we talked about last time. Just as before, we based our estimations on historical pricing data, thus measuring return as the expected return based on past stock performance, and the volatility as the standard deviation of returns, also based on the past performance. Once again, I need to emphasize that we extrapolate the past returns and the past volatilities for the future, supposing that the status quo will remain. In other words, the securities with higher historical risk and higher historical return also tend to show higher risk and higher return in the forecastable future. Another important thing we need to mention is that, again, the modern portfolio theory is based on the concept of perfect markets. So all the underlying conditions for the perfect market we have previously discussed will hold for this theory. In addition, we need to mention some other specific assumptions that we need to make when talking about the portfolio theory. First of all, we only take the variability of returns as the measure of a portfolio risk, thus making the standard deviation of return a single measure for risk. Investors also need to be risk averse, thus meaning that all others equal, each investor will prefer the portfolio with lower standard deviation to the portfolio with higher standard deviation. At the same time, investors also tend to increase consumption, thus meaning that they will always tend to maximize wealth, all others equal. Thus, the investor's utility function will be concave and increasing due to the risk aversion and consumption preference. That means that there is a set of investments which are of equal utility to an investor, and so the investor will be indifferent between a specific set of investments, even with different characteristics. Another important thing is that the modern portfolio theory, also known as the Markowitz model, is a single period model. And in this model, all investors, being rational in nature, do the maximization exercises, thus maximizing the return at the given risk or minimizing the risk at the given return. Now let's see how it works in the Harry Markowitz model. We'll start discussing the principles of portfolio selection by considering the portfolio of risky assets. At this point, let's suppose that investors only have the chance to invest in risky assets, which are the assets with non-zero standard deviation of returns. Here is the example of a portfolio of risky assets that includes 4 different stocks in equal weights. So that means that each stock in the portfolio has the weight of 25% by market value. Is this combination of the 4 stocks in the portfolio optimal? That's the question. And so, based on this, let's formulate the key question of this part. What determines the optimal combination of risky assets in the portfolio? From the previous lecture, we already know that all the assets available in the market lie in the feasible region, which is convex. Then, for example, each investment, a single stock or a portfolio comprising several stocks, can be represented as a point in the mean standard deviation chart with the given expected return and the standard deviation. The question is, let's consider portfolio A and find out whether this could be an optimal investment for some kind of investors. As you may see, I really doubt that some investors will choose portfolio A as the optimal portfolio. The reason is quite clear. Based on what we know already, we say that investors, being rational in nature, will maximize their utility with respect of their expected return and the standard deviation, thus meaning that a rational investor will prefer either portfolio B, the portfolio with the same expected return but lower standard deviation, or portfolio C, which is the portfolio with the same standard deviation but the higher return as an efficient portfolio. Investors may also prefer some combinations between B and C lying on the frontier for the feasible region. That means that as investors have a chance to choose the portfolio with better relationship between risk and return, then they will not invest in portfolio A if they act rationally. Another possible investment is investment in the minimum variance portfolio. As we know that variance is a squared function, then the feasible region will be concave and will have a single minimum point of the standard deviation, which is generally referred to as the minimum variance portfolio. A minimum variance portfolio is the portfolio of risky assets with the minimum possible variance, which can also be an alternative for some investors. But is that the case that all investors should prefer the minimum variance portfolio? I'm afraid that's not the case. We need the minimum variance portfolio in order to identify the optimal set of investment portfolios available to investors, which is called the efficient frontier. Indeed, as we can see and as we concluded from the previous examples, all the investments available at the market which provides the investors with the best possible combination of expected return and the standard deviation lie at the upper part of the bound for the feasible region. Another name for it is efficient frontier, which starts with the minimum variance portfolio and then goes up and to the right. This is the supply for the risky assets. But what determines the demand? As we mentioned in the background information for the portfolio theory, the demand for the risky assets is determined by investors' utility, which is represented by an indifference curve for each investor. As we know, each investor has its own attitude to risk. Some investors, like investor A, prefer portfolios with lower risk and thus agree to have lower returns. These are called conservative investors. On the other hand, investor B is more aggressive, thus agreeing to carry high risks for high expected returns. And all the portfolios that they are indifferent between lie on these indifferent curves. They start far from the upper left part of the expected return standard deviation space. However, very soon they realize that some investments are not feasible. So they start downgrading their preferences until they meet the supply. And the tangency points between the indifference curves and the efficient frontier are the situations where indeed the demand for investments made the supply for investments. And this would be the optimal choice for both investors A and B. You may ask which investor A or B is rational. In fact, the answer is both, because both of them optimize their portfolios based on their expectations about the risk and return. So let's summarize what we learned from this part. First of all, we say that all optimal portfolios of risky investments, which is also known as the supply for investments, should lie on the efficient frontier, which is the upper border of the feasible region. Then, we also conclude that all rational investors have their preferences for risk, which illustrates the demand for investments, represented by indifference curves. As the efficient frontier is convex and the indifference curves are concave, there should be a single tangency point between the efficient frontier and an indifference curve for a single investor. Thus, investors should choose the portfolios on the efficient frontier which are tangent to their indifference curves. This is where demand for investment assets meets supply. And this is what makes the optimal choice of the rational investor in the world where they can only invest in risky assets. Now we know that the optimal relationship between the risk and return is illustrated by the capital market line in the Harry-Markowitz model. Another thing that we know is that in order to estimate this relationship, investors need to estimate the slope of the capital market line to the horizontal axis. And as we can see, these are the two factors which determine that slope. The first one is the standard deviation of the tangency portfolio. Another one is the difference between the expected return of the tangency portfolio and the risk-free rate, also referred to as the risk premium. Taken together, they can form the right or rectangular triangle, and based on this we can determine the tangency of this angle and thus the slope of the CML. Actually, the tangency of the angle I'm talking about can be represented by the coefficient called the Sharpe ratio, which is frequently used in finance in order to determine the investment performance. Indeed, the Sharpe ratio equals the risk premium over the standard deviation of the tangency portfolio, and the optimization of portfolio returns in relation to risks means the maximization of the Sharpe ratio, which in turn will increase the slope of the CML to the maximum possible value. However, technically, as any investment can be represented as the point in the mean standard deviation chart, then the Sharpe ratio can be calculated for any asset which is available in the market. And by comparing the Sharpe ratios for different portfolios and assets, investors may find out which one provides a better combination of risk and return. Talking about the practical use of the Sharpe ratio, we need to notice a few important things. First of all, the Sharpe ratio can explain whether a portfolio's excess returns are due to smart investment decisions or are just a result of taking on too much risk. Although one portfolio fund can enjoy higher returns than its peers, it's only a good investment if those higher returns do not come with an excess of additional risk. The greater the portfolio's Sharpe ratio, the better is the risk-adjusted performance. If the analysis results in a negative Sharpe ratio, it either means that the risk-free rate is greater than the portfolio's return, or the portfolio's return is expected to be negative. In either case, a negative Sharpe ratio does not convey any useful meaning. Sharpe ratios above 1 are generally considered good, as this would suggest that the portfolio is offering excess returns relative to its volatility. Having said that, investors will often compare the Sharpe ratio of a portfolio relative to its peers. So that means that the portfolio with the Sharpe ratio of 1 may be considered a bit inadequate if the competitors in the peer group have an average Sharpe ratio above 1. However, this indicator has a number of limitations that I would like to talk about. Firstly, measuring the risk as a standard deviation implies that the returns are normally distributed, which may not be the case in the real market. Another limitation is a result of the popularity of Sharpe ratio among investment and portfolio managers, as it's often used as a benchmark for the investment manager's performance. Then some may manipulate it. For example, lengthening the measurement interval, which would provide a generally lower estimate of volatility, or, on the other hand, choosing the period when the portfolio recorded higher returns, thus overestimating the risk premium. In both cases, they can achieve higher Sharpe ratios, which will be an inadequate indicator of their performance. However, once their compensation is linked to such a key performance indicator, they may have an incentive to manipulate. A variation of the Sharpe ratio is the Cettino ratio, which removes the effects of upward price movements on standard deviation in order to focus just on the distribution of returns that are below the target or required return. There is another important thing we need to say about the Cettino ratio. It also replaces the risk-free rate with the required return in the numerator of the formula, making the formula for the return of the portfolio less the required return divided by the distribution of returns below the target or the required return. Here is the formula for the Cettino ratio, which looks more or less the same as the one for the Sharpe ratio at first sight, with these two differences we have just discussed. We can see that in the numerator we have not the risk premium over the risk-free rate, but over the target return, which can be other than the risk-free rate. However, in the divisor, we take the adjusted standard deviation, which is only the standard deviation of the downside risk. In general, using Cettino ratio instead of the Sharpe ratio may provide a more adequate estimation of the relationship between the risk and the return of the portfolio. Due to the fact that we only measure downside volatility instead of overall portfolio volatility, we can provide a better view of the portfolio's risk adjustment performance, because positive volatility can be treated rather than a benefit, other than the drawback for the investor's performance. Another thing is that in many cases the risk-free rate is not an optimal target or benchmark ratio for the portfolio investor's performance. In this case, they may prefer to choose a different return used as the benchmark, thus providing a more adequate estimate of a real risk premium. The model developed by Harry Markowitz provides us with the strong theoretical background for the relationship between the risk and return. However, it's not frequently used in practice because determining the tangency portfolio is not so easy when we have a big number of securities available at the market. That's why, in practice, the capital asset pricing model is a more popular way to explain the relationship between the risk and return. However, we need to know the fundamentals of the Harry Markowitz portfolio theory, because, as we will soon see, the capital asset pricing model is based on the Harry Markowitz model and is derived from that. We'll study the capital asset pricing model along with some other alternative pricing models in the coming lectures.